Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And I am sure there are lots of beginning options traders out there who've been looking at what the market's been doing. It's been ugly for the bulls, coming down and down and down, a little bit up today, but I think it might be foremost in a lot of minds out there. Hey, what about these bearish option strategies? And if I want a bearish strategy, which one's the one for me? Well, today we're going to be talking through three of the probably the most commonly traded bearish strategies: long puts, short calls, and bearish spreads, and doing a side-by-side comparison. Should be a really interesting discussion. Before we can get to any of that, though, let me first of all say hello to everybody that's already chatting in. Lots of familiar names out there. Hello there, Greg and Eva, Janelle, Chibwe, Kevin, Sharon, Free to Choose To, Chris, Jerry, Jay Richardson, Ricebird, everybody else. Thanks for joining us week after week. We really do always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, and there were a couple of names in there that weren't entirely familiar to me, welcome. It's great to have you here. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern. We'd love to have you here in the live stream audience. And as a treat here for our live stream audience, I have a good friend who's joining us today in the chats. Kevin, wait a minute. No, it's not Kevin, it's Kathy. I had to break down the initials there. Hello, Kathy, good to have you. Kathy and I just hosted a show together. Kathy Wynn is going to be helping out in the chats. Thanks for being there, Kathy. Kathy's role here is just to address any questions that I can't get to just during the flow of the presentation. Thanks for having my back. Also, I want to let everybody know, if you want to follow me on X, please do. If you have an account with X, you should be following your favorite presenters, your favorite coaches there. You can find me there at Cameron May CS. It's the best place to connect with me in between these live streams. But let's get right into this. Let's, of course, first consider the risks of what we're about to discuss. These disclosures are important, so bear them in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Options carry a high level of risk and are not suitable for all investors. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set an agenda for what we're going to be doing with our 45-ish minutes together today. We're going to be talking about bearish option strategies and how might a trader choose among the different strategies. Well, in order to make an informed decision, we really need to understand the pros and the cons of maybe our favorite bearish option strategies, whatever those might be. So what we're going to do today is look at an example stock to set up a bearish sort of trade scenario. And then we're going to go to three strategies, three of what I consider the most common bearish strategies. Those are buying a long put, selling a short call, and doing a bearish spread. And we're just going to break them down. We're going to look at them side by side, look at what sort of reward potential they carry, what sort of risk they carry, what the likelihood is that the trader's actually going to make money on that trade if they wind it up and let it go, all of those sorts of elements. So it should be a really interesting discussion. Let's go right to Thinkorswim and set up the trade scenario. So this is the Thinkorswim desktop paper money software platform that can be downloaded free of charge from within your Schwab online account. You just go to the trade tab and look for Thinkorswim. You can download it right there. But let's look at what's going on with Morgan Stanley from a charting or a technical perspective. You can see that we hit a peak, much like the rest of the market, right here in that third week of February. And Morgan Stanley has sold off since then. Had a pretty severe sell-off, bit of a bounce recovery, another severe extension of that sell-off, bounce recovery, getting a little bit of bullishness today. But overall, what a technical trader might notice is it appears that we have, at least for now, intact lower highs and intact lower lows in this sort of intermediate time frame. Now, is it possible that today's bullishness just continues and this is the start of a recovery? For Morgan Stanley, certainly could be. Nobody has a perfect insight into where things are headed from here. But let's just suppose that our hypothetical bearish traders look into markets. They're not thrilled with what's going on from a bullish perspective. They think maybe there's more downside potential for the markets, and they expect potentially the same thing from Morgan Stanley. It's rallying up here to short-term highs. Maybe they think that's about as high as it's going to go, and more likely it's going to turn and head down. So let's plan a bearish trade of some kind for the May 16th expiration. We just don't know which kind yet, because the trader here has a number of strategies at their disposal. Now, obviously, I can't go, oh, and Anup says, how did you choose Morgan Stanley for the example? So obviously, Anup, one of the roles one of the considerations here was what I seem to see on the chart. So for a technical trader, it's quite common to look for a stock that's been moving downward, but that's recently pulled up to a price ceiling. Maybe that means that it's about to turn and head downward again. Obviously, again, time will tell there. But other potential important considerations, because it's a really good question, are the price per share of the stock. Higher priced stocks tend to have higher priced options for better or for worse, but they can also have more options to choose from. Those low priced stocks tend to have relatively few strike prices to choose from. So when constructing, let's say, multi-leg strategies in particular, there can be some limitations there. So that's a consideration, but also liquidity is probably, for a lot of traders out there, it's a primary consideration, because an illiquid stock tends to have illiquid options, and that can lead directly to pricing issues. It can widen the spread between the bid and the ask price very commonly, make it more difficult to trade those profitably. And options, as with any approach to trading, are already hard enough to trade profitably, right? We don't want to shorten or we don't want to reduce the probability. Hopefully, the trader is looking to increase the probabilities of success here. And so, yeah, illiquid options can be an issue. It can be an obstacle in that effort. So there are a few considerations. Now, obviously, traders can have other commitments. You know, what's happening in the broader economic perspective of what's going on with the markets. You know, maybe they think that Morgan Stanley has higher exposure to whatever it is they have concerns about economically, tariffs, whatever that might be. But for me, it was, for the selection of this stock, primarily price, liquidity, chart. All right. So let's just say that our trader thinks we're about to bump our heads here and head downward. Let's start to outline a comparison of three strategies. And there are a number of things that a trader might want to weigh in their minds as potential pros and cons for each strategy. So let's outline those generically and then apply those to the specific strategy. So first of all, we want to name the strategy, apparently. Let me make this bold. But we're going to have our strategy. We're going to have the cost of the strategy that we're going to compare one to the next. We're going to look at potential for reward for each strategy, the risk scenario for each strategy, where the break-even level is. Let's put that on a separate line. The probability of breaking even. Now this one, I think let's just quickly revisit these. Cost, yeah, that can be a consideration. The potential for reward, sure. Risk, sure. Break-even levels, probably want to understand that. Probability of break-even is the attempt to address the question, Cameron, if I do this trade, if I employ this strategy, what are the chances that I even make any money at all? Just eke out a penny or a dollar. Well, that's really, to phrase that a different way, what are the chances I at least break even on this trade? So that's, we're going to give some extra emphasis to those probabilities. And then finally, we want to look at between the time of the entry of the strategy and expiration, what's the probability that something else enters the equation in the form of assignment of a contract? So early assignment risk. All right. So if our trader really understands these elements of the trade, they probably have a pretty fair shot of choosing the one that seems most appropriate for their tolerance for risk, their desire for potential for reward, and all of the rest. Will says, howdy, sorry for being late. Welcome, Will, great to have you. Always good to see you. But let's start with our first strategy. I think this is the one that might spring to mind first for a lot of traders. When they think bearish, they think, oh, that just means a bearish option strategy is to buy a put, right? Well, that's one of the strategies. It may be conceptually the most direct strategy, but is it the best strategy in all scenarios for all traders? Probably not. Okay, but strategy number one is going to be a long put. So let's just look at this, and let's keep it fairly simple, okay? If we think the stock is going to go down for a while, how about we just look at buying a put for the May 16th expiration, okay? And since the stock's trading right around 110, let's go with at the money. We're going to compare similar strikes for each of these strategies to try to make this as standardized an analysis as possible. So let's go to the 16th of May expiration. Let's go to the 110 puts, and it looks like those are trading between 445 and 465. Let's call it 455. That's the cost of our trade. Now, on the when we're comparing these strategies, I'm going to use some fairly generic language. Generically speaking, what we'd say the cost of this trade is, it's just the debit for the premium. And when compared to the other strategies, we're going to learn that that one's sort of high. It's a relatively high cost to our other strategies. Interestingly, not the most expensive, if that's the way we're going to discuss things. But the cost for this example is going to be $4.55. That's a debit. It's a relatively high cost. What is the potential for a reward here? And as a matter of fact, it might be helpful if I put the trade details in here. So this specifically is going to be by the 16th of May, 110 put, and that's it, because we're going to have the cost right down there. Okay, so that's our long put. What is the potential for reward on this strategy? Well, if we look at the terms of the contract we're entering into, when we spend that $4.55, that means that our trader here has the right to sell shares for $110 at any time between now and the 16th of May. So if the stock collapses in value, they have an advantage over just market price. If the stock falls to $110, they have the right to sell shares for if the stock falls down to $100 and they have the right to sell shares for $110, hey, they have a $10 advantage over market price. If it falls further, that advantage grows. The potential for reward is actually, let me use kind of a squishy phrase here, but there is a huge potential for reward. Really, the further the stock falls, the more the reward has the potential to grow. So this $4.55 investment could grow to be worth as much as $110, because if the stock is essentially sunk to zero in value, but we have the right to sell shares for $110, that's a $110 advantage over market price. So we'll just say the potential for reward is huge, all right? This is actually, among the strategies that we are going to be examining, the highest potential reward. Leon says you're a Cameron May fan. Well, thank you, Leon. Appreciate that. Agnieszka says, why May 16th expiration? I just picked sort of a random expiration just for points of comparison. We could have done this with any expiration. So if you're struggling and you don't know which expiration to choose for whatever strategy you're selecting, let me make a suggestion here. First of all, make sure, if you haven't done this already, subscribe to our Trader Talks channel on YouTube. It doesn't cost anything to do that. It only takes a second. You do that by going down and clicking on the subscribe button down below the video stream right now. Just click subscribe. But once you're subscribed, go to YouTube and look for our Trader Talks Schwab Coaching webcast channel. I have two recommendations for you here. Number one, this is for everybody. There's a new feature on our on our Trader Talks channel. How many of you noticed that we just added this area? We're just starting to produce what we call YouTube Shorts, little 2-3 minute videos that are instructional. So a great one that was just added. I watched it. It was done by Brett Crowther. Right there, how to use the market forecast tool. It's a proprietary tool on the Thinkorswim desktop platform, yeah, you can watch that short right there. So if you haven't checked out these shorts, you can get through all of the ones that we've just created within just a few minutes. We're going to be adding those regularly, so make sure you check those out. But the other thing that I wanted to point out, if you're struggling in, let's say, selecting an expiration, let me go to the playlist for this webcast series. So if we go to playlists on our Trader Talk Schwab Coaching webcast channel, you can find all of our webcast series here. And this one's called Getting Started with Options. So I'm going to scroll down. It's right toward the bottom. So as we scroll all the way down to the bottom, there it is, Getting Started with Options. I'm going to click on View Full Playlists. And I just did one just a few weeks ago called Mastering Understanding of the Element of Time in Options Trading. Selecting that expiration was a focus right there. All right. So check that one out. Eva, you saw the shorts there. Janelle, AC100, you love those? Yeah, Scott's done some. Yep. I'm sure we're gonna be spreading the wealth around a little bit. You'll probably be seeing the rest of us doing those shorts here in a very short order. Anyway, yeah, there you go. So just to address that question about why I chose expirations, this one was kind of random. I just said, let's say we're a trader and we think stocks are going down for a little while, so let's go out for that amount of time. Anyway, but the potential for reward on our long put is pretty big. I don't care what phrase we use. It's big, huge, massive. It's not unlimited. Some strategies can actually carry that, but it's big. Okay. What is the risk potential here? Well, the risk on this is actually limited. It's limited to the debit that we spent. And in this case, I'm going to say that that risk is going to be lower, but not lowest in this comparison that we're going to be doing. It's going to be lower than one of the strategies, but higher than the other. It's sort of in the middle. So when we spend $455 for the right to sell shares for 110, if the stock goes up in price, we thought it was going to go down, and we have the right now to sell shares for less than they're worth, that's not worth a lot. And if the stock gets all the way to expiration, still above our strike price, we could lose that whole investment. But that is, the risk is limited to the debit, assuming this sort of a thing doesn't happen or we don't tinker with this strategy. All right, so where's the break even on this trade? There's a pretty straightforward equation to figure out the break even on a long put position. You take your strike price and subtract from it the price that you paid for the put. Okay, so we take our strike and subtract the debit. So what would that be? We have a 110 put that we paid $4.55 for. So in this case, that would be what would that be? 105.45. And that's actually going to be, well, I'll just leave it there, okay? 105.45. So why is that the break-even point? Well, think about this. Let's say the stock, we have this contract through the 16th of May, and let's say we buy the contract, we stick our heads in the sand, we come up for air after the contract is expired to discover that the stock is trading at 105.45. And we think, awesome, because we have the right to sell shares for 110. Hey, that's a $4.55 premium above what the current price of the stock is. So, hey, we have a $4.55 contractual advantage above the markets. But we paid $4.55 for that on day one to gain that advantage. If we pay $4.55 for a $4.55 advantage, my math says that's a wash. My math says that's break even. So, yeah, this stock actually has some work to do. So you might look at this and say, hey, we're above 110 and our break even is at 105.45. These are bearish strategies. With each of these strategies, we need the stock to go down to wherever break even is. Really, to be making money at expiration, we need to be below that break even level. So we are not above break even right now in a positive way. We're above break even right now in a negative way. All right? So what is the probability of actually breaking even on this trade? You may notice this stock needs to get moving. We're still $5 above break even. I can do the math on that. I can see that this is going to be a lower probability scenario. Look at their chart. Our break even on this trade, let me get rid of this one drawing here. We're up here. We just calculated our break even is down at 105.45. And for the moment, the stock's going in the wrong direction. But we're about there. That's about our break-even point. So we need to go down and get down below here before expiration to be at break-even at expiration. All right? Well, we might go down or we might go up. Let's call that 50-50. There's a less than 50% chance that we're going to be at break-even or in a more beneficial position at expiration. So I can probably already calculate that the probabilities here of success on this trade are not strong. How can we check those probabilities more precisely? Well, actually, there's a tool right here on the Analyze tab called the Probability Analysis tool. And it's a nifty little grid that lines up prices with dates. So let's look at a price of 1045 lined up with the date of the 16th of May. There's the 16th of May. I can just move my cursor up to 105.45. Let's come right to about there. That's close enough. As I do that, you'll notice there are two numbers. There's an intersection, crosshairs. There's a percentage above and a percentage below. 63.44% that we've not managed to get below and stay below break even. Or in other words, let's do some reverse math there. About 36.56%. I know it's obscured. Let me take my hands off my cursor because I can kind of botch this up. And the percentages will change as price is moving behind the scenes. But yeah, there's about a 36.5% chance. Let's just put that here. The probability of breaking even on this trade, if we take this trade, it's about 36.5%. There's about a 1 out of 3 chance that if we buy this put and let it go to expiration, that the stock has moved far enough that we've made enough money to put us into profit territory or at least breaking even. Are those strong odds? Does this have a high probability of success of making at least some money? No, actually, this has the lowest probability of success of any of the strategies that we are going to be examining today. All right, now finally, we have something called early assignment risk. That's if we sell a short option, what's the likelihood that the owner of that short option decides to assign the contract early? Well, this isn't a short option, this is a long option. There is actually zero risk of early assignment since we are the owner of this put. So that's easy enough. All right, let me do this. I'm going to put this, just so it sort of stands out. Let's put this in all caps. Long put. There we go. So that is starting to describe for us this strategy. Now let's do a comparison. Let's copy all of this. Really what I should have done is copied it before I put in all the information. Oh well, forgive me. Let's paste it here and do a second strategy. And this is a short call. So in this case, let's stick with the same expiration. Let's stick with the same strike price, but we are going to, oops, let's take the caps lock off. We're going to sell the 16th of May short call. So let's see what that's going for. If we come down here to the 110 call, that looks like that's trading between 430 and 440. Maybe we get a 435 credit. But wait a second, this is a credit. Not a CBIT. So is there a cost here? We're getting a credit. So, oh, hey, we're starting out of the gates without even any money out of pocket. Yeah, sort of. If we choose to accept this credit of 435, let's say we put it in the order, and here what's happening is somebody's conceptually paying us 435 bucks for the right to buy 110 shares from us pardon me, 100 shares from us at $110. Yeah, we're getting a credit, but we also have this big obligation attached to that credit that we've collected. And there is, and I'm assuming here that we don't actually own the shares. This is just a short call, not a covered call, just a short call. Well, this has a sort of a hidden cost to it, but a direct cost. It is a credit, but it has a margin requirement. What is that? Well, it means we've gotten ourselves into a contract here. Well, somebody has the right to buy 100 shares from us. If we don't own those 100 shares, we better be able to at least partially be able to buy the shares if we need to. So when we place this trade in a margin account, there's an initial margin requirement. And here's a quick way to see how much that might be. We'll go to our strike price. I'm going to go to the bid price and click to sell a call. We're just going to do one call, just to keep it fair. It's a one put, one call. And let's say 435. Let's lock that in at 435. I'm going to click confirm and send. And notice right here, it says, Cameron, there is a buying power effect of $2,213.90. In other words, that's how much of our own cash we need to tie up in case we need to buy some shares. Okay? So that's the margin requirement for this trade. If we look at that in a per share terms, it's $2,200 for 100 shares. That's about $22 per share that are being tied up. Do some math for me. Does it cost, let's put cost in air quotes, does it cost more to spend $455 to buy a put, or does it cost more to tie up $22 per share to sell this call? Actually, the cost, and maybe here I need to put this cost in parentheses, in quotes. This is actually the highest. That to some traders is counterintuitive because we think, wait, we're getting credit. Doesn't credit mean no cost? Well, it depends on how you define cost. If we're just looking at cost as how much we have tied up in a trade, this is the pricist. All right? That is an important consideration. It literally translates to if we're going to get crazy with it, we're going to buy or enter as many contracts as we can actually, quote unquote, afford to do more of these than do these. All right. So what's the potential for reward? Well, in this case, when we receive a credit, the potential is equal to that credit. That's how much we can make. The objective here is just to hopefully sell the contract, in this case, hypothetically at $4.35. We're looking for this contract to just expire worthless, and that would be our maximum reward on this trade. So is this the highest reward? No. This one has huge reward potential. This one has limited reward potential, but it actually is going to prove to be higher than our final strategy. Okay, what's the risk here? Well, if anybody is familiar with short calls, if we don't own the stock and we just have sold what we call a naked call, it has unlimited risk. So let's just put that right in here, and I'll explain why it has unlimited risk. This is the highest risk. Okay, we're getting ourselves into a contract. Somebody's paying us $4.35 in this example, and in exchange, they have the right to buy shares from us for $110. So we know how much we might have to sell the shares for. We don't own any shares, so if we're required to sell the shares at $110, we've got to go get shares from somewhere. We might have to go buy those on the market. Well, what if those shares have gone up dramatically in price? Let's say they're $150. Let's say they've gone to $200. Is it likely for Morgan Stanley to go to $200 in the next 24 days? No. Could it? Yes. If the shares are up at $200, we have to buy them at $200 and sell them at $110. That's a $90 loss set against this $4.35 that we've collected. Yeah, that's a lot of risk. And the higher the stock goes, the higher that risk reaches. So this is a strategy with unlimited risk. For some traders, that eliminates it from consideration right away. For others, it actually doesn't. All right, where's the break even on this trade? Well, the break even equation here is actually we take our strike and add to that our credit. So in this case, if we have that 110 strike and we've collected a 435 credit, that gives us a break even of 114.35. For example, if I go back and replace this trade, let's say we're still insisting on that 435 credit, and we click confirm and send, you'll notice our break even is calculated right here at 114.35. Here's why. Let's suppose we get into this contract, we accept the 435 payment, and then the stock doesn't go down as we hoped it might, but instead it starts shooting up. And let's say it goes up to 114.35 at expiration. Well, we have to sell the shares for 110. We might have to buy them for 114.35. That's a $4.35 loss on the stock. Oh, fortunately though, we collected a 435 premium up front, so that's a wash. So that's break even. So really, a different way to describe this is as long as we're below 114.35 at expiration, we're at least breaking even. And guys, we're already $4 below that. This is a much different probability scenario. And as a matter of fact, we can just go back to our familiar tool here, go to our probability analysis, and go up to, let's go to 114.35. That's close enough. Right around, that's as close as I'm going to get it. But it looks like it's around, there we go, around 64% probability of success. Let's put that in here. So our break even is 114.35. We need to be below that at expiration. There's about, let's call it a 60, let's do it one more time. 114.35 was right about there. Yeah, about 64%. We'll call it 63.6%. It's just to be more precise. This is actually the highest probability for our 3 trade scenarios that we're going to discuss. Now, this is a short option though, and short options can be assigned before expiration. With this trade, the trader typically is hoping for the contract to just expire worthless. This assignment risk, the other trader here that we've sold these contracts to can decide at any time to buy those shares from us for 110. Well, that assignment risk varies. It varies according to a number of variables, but primarily the closer we get to expiration and the further the further the contract goes in the money. In other words, if the stock is above 110, and we're getting closer and closer to expiration, that can dial up that risk of early assignment. So that assignment risk is present. If the stock is going down below 110, that assignment risk diminishes, but is still present. All right. So I am going to say one thing. Is it always bad if the trader, no, forget it. Never mind. No, I'm going to come back to that for our final trade. Now, look at these 2 strategies, and you'll notice that there are distinct advantages and disadvantages between the 2. I know that somebody out there is probably looking at one of these and saying, like, for example, there's probably somebody out there saying, well, Cameron, you're telling me I can only lose $4.55 here, and I have huge potential reward. I don't care about this probability. I know I don't have strong odds, but hey, I could make a ton of money. So that's the trade for me. Others might be saying, hey, I have a limited reward potential on this trade, right? I have a limited reward. I can only make as much as I receive as a credit, but I have a high probability of success here. I'm willing to surrender some of the reward potential to dial up the odds of success on the trade. At least, breaking even, I've got at least a 63.6% chance. So, Janelle said, don't forget to come back to your statement, Cam. What was my statement? Now you got me worried. Anyway, yeah, there are pros and cons to both of these. What I want you to take away from this discussion is there's not the perfect strategy where I can just say, this is the one for everybody. You'll finish your thought at the end of this session. Oh, yeah, this one. Yeah, I'll definitely do that, Janelle, no doubt. Because we have a third strategy to cover here. So let's get into that. First of all, let me just double check this, make sure that I put in everything that I wanted to. Unlimited risk, strike price credit, probability of break even. Yep, I'm happy with all of that. So let's just copy this and let's build out one more example strategy. Let's paste this here. I'm just going to quickly clear out each of these. Actually, let's leave that one, but there we go. Oh, this might not be a good idea. Now let's fill them out one at a time. That's getting messy already. I don't like it. Oh, no, that's okay. Cost, potential reward. Yeah, that's okay. Anyway, let's start to map out our third strategy. Now, we've talked about just going with a long put. We've talked about selling just a short call, or we could do a spread of some type. We could do a credit spread, or we could do a debit spread. And you might think it's important. Well, which one? I've actually done a comparison in the past between credit spreads and debit spreads, and for almost all intents and purposes, they're essentially identical strategies. So this third breakdown could actually apply in probably equal proportion to either a credit spread or a debit spread, as long as we're doing it on the same stock, same expiration, same strike prices. So for this one, we are going to do a spread, but we're going to do a long put spread. Okay? Which involves the first element of buying that 16th of May put, but at the same time, we're going to sell another put. So let's go pick one. Okay. We're going to stick with the same expiration, 16th of May. Let's go to our trade tab. And if we're buying the 110 put, we want to sell a put that's at a lower strike price. How about we just go a couple of bucks down? Let's maybe sell the 16th of May 108 put. All right, what is the cost of this trade? Well, if we're spending basically $4.50 for the 110 put, and we're collecting a little bit more than $3.50 for the 108 call, that's going to leave us out of pocket, what, about 90 cents? Let's quickly check that. Let's come up to our spread single. Let's go deep and wide, 2 strikes wide, vertical. That's 108, 110, yeah, 70 cents to $1. Looks like it might be about 85 cents. Okay, so let's put that cost in here. What do you notice about the cost of this trade? It's lower than our put. It's lower than this margin requirement on our call. This is the lowest cost of our trades. All right. What's the potential for reward? Well, with a spread, let's come back here. Let's set this back to single. That's okay. When we spend 85 cents to get into a $2 wide spread, we take the width of the spread, $2, and subtract the cost, and that tells us it's the spread width minus the debit. So in this case, that would be $2 minus 85 cents equals what, $1.25 that we could make? We have a huge reward potential up here. We have a limited reward potential here, but still larger than this one. This is our lowest reward potential. Lowest cost, lowest reward. Now, we could change things a little bit to dial either of those up, but yeah, lowest cost, lowest reward potential. What is the risk? The risk is equal to the net debit, which again is the lowest risk of the three. $1.15, thank you for correcting me. Yep, I can make mistakes. So do that if you ever see me make because I'm teaching and talking and doing all kinds of things, and it's easy for me to just miss something obvious. Yeah, $2 minus 85 cents is not $1.25, it's $1.15. Thank you. All right, but our net debit is the amount that we can lose. We can lose the investment here, which is 85 cents. That's the lowest risk. Oh, okay. So for the risk averse, they might be leaning toward this strategy. What is the probability of break even? Well, how do we calculate this break even? Here's a calculation for determining the break even level for any bearish trade strategy. We take the lower strike and then add to that the max gain. Or in other words, in this case, we're calling it the potential reward. Let's keep it consistent. Okay. So in this case, our lower strike is 108. Our potential reward is 115. So where does that make our break even? 109.15. So this would be, is this the best, the most favorable break even? Nope. The short call is actually a little bit more favorable than that. It is a higher break even level than the long put. So we'll just define this as a higher break even, but it's not the best one. What's the probability of breaking even? If we just need to be below 109.15, let's have a look at our Analyze tab. There's 116, or there's May 16th. Let's go to 109.15. There's close enough. It's about 50%. Maybe we're going to call it 50, yeah, about 51%. So this is higher, but not the highest. It's higher than our long put, but it's not the highest. And finally, what about our early assignment risk? Well, it varies, just like with our short call, but with our short call, typically the trader does not want to be assigned. With a long put spread, actually assignment is the desired outcome. So it varies, but it's likely desired. Okay, here's why. If the owner of the short put that we sold, they have the right to sell shares to us for 108. They decide to do that, sell us the shares at 108. Well, we have the right to sell those right on to somebody else for 110. Hey, sell me those shares at 108. I sell at 110. That's a $2 gain for which I spent 85 cents. That's my maximum gain outcome. So yeah, there is early assignment risk, but it's probably desired. So there we go, guys. With this as an outline, our trader might be able to weigh the pros and the cons. There are a number of questions a trader should probably be asking themselves before selecting a strategy. How much can I make? How much can I lose? What's the probability I'm going to make any money at all? Is there some risk that something unforeseen can happen before expiration? All of those sorts of things. So guys, we've actually accomplished a side-by-side comparison of 3 bearish strategies. So which one's the right one for each trader? It's up to them. But hope this has been helpful for you, guys. We've set up the trade scenario. We've broken down 3 potential strategies, and we've analyzed the pros and the cons of each. If you enjoy these kinds of webcasts, this is what we do on Tuesdays. I want to invite you to continue to follow me and join me in these Tuesday webcasts. I also want to make sure, again, that you're subscribed to our Trader Talks channel on YouTube. This is where we house our playlist for previous webcasts and where you can join the current ones. So make sure that you click on the subscribe button if you haven't done that already. It only takes a second and doesn't cost anything. Also, make sure that you're following us on X. You can follow me on X at Cameron May CS. It's the best place to connect with me in between these live streams. And everybody, thank you for the thumbs up. I can see 172 people watching. There are 44 that have already clicked that thumbs up button, the like button. That's very much appreciated. It feels like applause to me. And it also gives my webcast a boost in the YouTube algorithm, helps more people find these sorts of things so they can intelligently weigh the pros and the cons of different strategies. So everybody, I'm going to let you go. Go enjoy the rest of our webcasts. I'll look for you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.